In this chapter, we'll be covering bonds. When corporations raise funds by borrowing, they issue bonds. We'll cover the key features of bonds, how they're valued, beginning with bonds that pay interest annually. So what is a bond? A bond is a long-term debt instrument issued by corporations, governments, and government agencies to raise funds. Bonds are interest-only loans. The issuer agrees to pay interest periodically and to return the principal at maturity. Bonds are called fixed-income securities. Most bonds are traded over the counter among large financial institutions. The Wall Street Journal does report key stats on treasuries, corporate, and municipal bonds. Let's look at the key features of a bond. The par value is the face value. It's usually $1,000 for corporate bonds. For plain vanilla bonds, this is the selling price and the amount repaid at maturity. The coupon interest rate is the stated interest rate. It's fixed for plain vanilla bonds. The rate paid periodically by the issuer. The couponed payment is equal to the interest rate times the face value. It's called the couponed rate because early bonds came with coupons attached that were removed and submitted to receive the payments. The maturity date is the date the bond issue is to be repaid. The issue date when it was issued. Yield to maturity is the rate of return earned on a bond if held to maturity. It's the market-required rate of return on bonds of similar risk and maturity. It's quoted as an APR. This becomes important later. At the time of issue, the yield to maturity is usually equal to the couponed rate. Other bond features. A convertible bond can be converted at the holder's discretion into a specified number of shares of the firm's common stock. This is an attractive feature for bond buyers. They can share in the growth of the firm, and the issuing firm can offer a lower couponed rate. A warrant is a long-term option to purchase a stated number of shares of the firm's common stock at a specified price. Warrants are considered sweeteners. They can be detached and sold separately. A puttable bond allows the holder to require the issuing firm to buy the bond back for face value. A put option is usually triggered by some event, such as a hostile takeover. Income bonds only pay interest when the firm earns enough. Not good. Indexed bonds offer a coupon rate indexed to some benchmark rate. The U.S. Treasury offers TIPS, Treasury Inflation-Protected Securities, which adjust for inflation. Most bonds now have a call provision, which allows the issuer to recall the entire bond issue. This is good for the issuer, not good for the bond holder, so bond buyers would require higher yield. Most callable bonds include a declining call premium and a deferred call provision. The call premium is the amount paid in addition to the face value to the holder to recall the bond. Frequently, the premium starts out as one coupon payment and declines over time. Many callable bonds guarantee that they cannot be called, say, for the first 5 years. Think of this in terms of refinancing your home mortgage. You would do it when the market rates decrease enough that the added expense of refinancing is worth it. The same is true for a corporation. Consider a 30-year bond issue with 25 years remaining, paying a 6% coupon. If market rates decline to 3.5%, the firm can recall the entire issue and issue new bonds paying 3.5%. Some bond issues include a provision called a sinking fund. A sinking fund provides for the orderly retirement of the bond issue periodically over the bond issue's life. A firm would include a sinking fund provision to reassure bond buyers that they will be repaid. A sinking fund provision allows the bond issuer to offer a lower coupon rate. Funds are deposited with a trustee each year to execute the sinking fund provision. How a sinking fund works? There's 2 ways. A certain percentage of the issue is called each year through a serial number lottery. This would be used if the bonds are selling for more than face value. In other words, the coupon rate is higher than the current market rate. Or the trustee can buy the bonds in the open market if the bonds are selling at a discount. Let's take a minute to look at what makes up the required return on a bond. The required return on a bond is the yield to maturity and the discount rate used to value a bond. The required return on a bond is the rate that could be earned on bonds of similar risk and maturity. The components of that rate include the real risk-free rate, to compensate the buyer for the time value of their money, an inflation premium based on expected inflation. The risk-free rate plus the inflation premium is equal to the nominal risk-free rate. A maturity risk premium, Longer-term bonds have to pay a bit more since they tie up your money longer. A default risk premium based on the potential for default. U.S. Treasuries have no default risk. And a liquidity premium to compensate investors if the market for these bonds is not liquid. The market for Treasury bonds is highly liquid. The market for corporate bonds is very illiquid. A basic premise in finance is the value of any financial asset is the present value of its expected future cash flows discounted at an appropriate discount rate. Valuing a bond is relatively straightforward since the parameters are defined at the time the bond is issued. We know what the coupon payments will be and when they'll be paid. We know what the face value is and when it will be repaid. The value of a bond is the present value of the coupon payments plus the present value of the lump sum face value paid back at maturity. Since the value of the bond is based on a present value, the value or price of a bond moves inversely to market interest rates. As interest rates rise, the value of a bond declines, and vice versa. This breaks the bond pricing equation into the annuity portion, the coupon payments, and the lump sum, the face value. We'll use the TVM keys to value bonds. FV is the face value, usually $1,000. It's positive. Present value, PV, is the price of the bond. It's negative, what you pay to buy the cash flow stream. IY is the yield to maturity. It reflects the current market rates for similar bonds. The yield to maturity is usually equal to the coupon rate at issue. After issue, the coupon rate is fixed. The yield to maturity changes with the market. N is the number of periods to maturity. PMT is the coupon payment. In Excel, we'll use the same TVM functions we covered in Chapter 5. Note that the type is always 0 for a bond. They're ordinary annuities. Let's look at a simple example. What is the value of a 10-year bond with a 10% annual coupon rate paying interest annually when the required return is 10%? Note that when the coupon rate equals the yield to maturity, the bond sells for its par value. This is always true at any time during the life of a bond. Here's the same bond value solved with the TVM keys. N is equal to 10 years. IY is equal to 10%. The payment is equal to 100, 10% times 1,000. Future value is $1,000. The lump sum, compute PV, minus $1,000, what you'd pay to buy that. But what if the coupon rate on the bond was 13%? With a required return of 10% and a coupon rate of 13%, holders of this bond are getting a higher coupon payout than they can currently be found in the market. The bond sells for greater than $1,000. It's a premium bond. What if the coupon rate were 7% with a 10% required return? The bond will sell for less than $1,000. It's a discount bond. While this bullet-shaped graph is very symmetrical, a bond's value over its life may be at a premium at some times and at a discount at other times, based on market rates. What this chart does demonstrate is that as a bond moves toward maturity, its value converges to $1,000, whether from below or above. At maturity, the value of any bond must equal its par value. If the required return remains constant, the value of a premium bond would decline over time until it reached 1,000. The value of the discount bond will increase until it reaches 1,000. Par value will stay at 1,000. So far, we've looked at how to find the price of a bond, but the truth is bond prices are quoted. What is not observable is the yield to maturity, the market required rate of return on a bond. Yield to maturity is the discount rate used to value a bond, and as it changes, the value of the bond changes inversely. Yield to maturity is also the return earned by an investor who buys the bond and holds it to maturity. As we mentioned, the coupon rate usually equals the yield to maturity at issue, so that the bond will sell for its face value. Yield to maturity is quoted as an APR. When we look at bonds that pay interest semi-annually, this will become important. Computing yield to maturity using the TVM keys is straightforward. Remember the sign convention. N is the number of periods to maturity, the number of years for an annual payer. PV is the price of the bond. It's negative. Payment is the periodic coupon payment. It's positive. Future value is the face value, usually $1,000. It's positive. Compute IY. For example, we have a 10-year 9% annual coupon, $1,000 par value selling for $887. We're looking for the discount rate that equates the cash flow stream of coupons and face value to the current price. It's possible to solve this manually, but in an iterative manner, since we're trying to solve for the root of a polynomial of degree n. Much easier to use a financial calculator. Solving our example, we find an interest rate of 10.91%. This makes sense since the bond is selling for a discount at $887 versus $1,000, so the yield to maturity, the market rate, should be greater than the coupon rate. Continuing the example, if the same bond is selling for $1134.20, then the bond is selling at a premium, so the yield to maturity should be less than the coupon rate, which it is, 7.08%. When bond information is quoted in the financial press or online, the yield quoted is called the current yield, which equals the annual coupon payment divided by the current price. Assets can only generate return in two ways, cash or capital gains. Current yield can be considered a measure of the cash yield of a bond. Yield to maturity is the total return, and it must equal current yield plus capital gains yield. Continuing with our sample bond with a 9% annual coupon selling for $887, the current yield is equal to $90 divided by $887, 10.15. With a yield of maturity of 10.91 and a current yield of 10.15, then capital gains yield must be the difference, 0.76%. You could also find the expected price 1 year from now and divide the change in price by the beginning price, which will give you the same answer. Bonds are subject to two basic types of risk, price risk and reinvestment risk. Price risk is the risk that a rising yield to maturity will force the value of a bond down. As you can see on the slide, price risk affects longer maturity bonds more than shorter-term bonds. Reinvestment risk is the concern that as market rates fall, you'll have to reinvest cash flows from a bond at rates lower than you were earning on the bond. An example will help clarify reinvestment risk. Suppose you just won $500,000 playing the lottery. You intend to invest the money and live off the interest. You have two options. Invest in a 1-year bond paying 10% and reinvest each year. Invest in a 10-year bond paying 10%. If you choose the 1-year option and rates fall, your income will fall, but you'll benefit if rates increase. If you choose the 10-year bond, your income is fixed, but you won't gain from a rate increase. Bottom line, nothing is riskless. Long-term or low-coupon bonds are subject to more price risk. This is because more of the bond's total value is further in the future and is hit harder by discounting. Short-term or higher coupon bonds are subject to more reinvestment risk because the bondholder will receive more income sooner and need to reinvest it. This ends the first part of Chapter 7. In the second part, we'll finish with bonds covering semi-annual payer bonds and bankruptcy.